The S&P and the NASDAQ were down. Everything was down. And NVIDIA said, cheerio, we're going higher. Okay? So we're going higher. Got the John Cena sound.
You what?
Soundboard is hot today. Okay, so let's have a look at what we are kind of dealing with today. You got the S&P 500 up, 0.28%. Got the NASDAQ up 0.37. These are modest bounces after yesterday. You were down a good bit here. You had, the NASDAQ down just about 2% from peak to trough. That's not a nothing sell-off. That being said, though, this market to me, just wants to keep melting up. Now, that could be famous last words. Maybe this market's due for a bigger pullback. I did mention yesterday that I think the market's due for a pullback, but I also cautioned that pullbacks might be brief. To be honest, I wouldn't mind being able to build some positions out. There are some stocks that I want to buy and put in the portfolio. There are things that I want to do with a more constructive stock market dip. Okay. But my reaction here to price, or my first estimated guess, my educated guess, probably buyers are there. Now, if it doesn't happen, if it breaks, I'd actually be happy with that, because then I like I said, I could build out some positions that I've been wanting to, if I can get a bigger pullback in the market. But there's a good chance, I would say, this market looks very strong, that could have been the dip. As crazy as that might sound, this market has done crazier things in recent times. For a long time, the play was a 2% pullback was all you'd get. You'd be lucky to get a 2% pullback, when you're looking at the S&P. 2% was pretty much mostly the moves. Now you had this April sell-off, and you saw 6.6%, but this market, in my opinion, just wants to go higher. Yields are under control. The economy has sufficiently shown signs of a little bit of slowdown. Now, you might point to yesterday's PMI numbers and say, well, hold on just a second. PMIs were strong, but you also had really strong earnings. Most of the data, the jobs data, is tame to a degree, relatively speaking, to what we've been seeing in recent months. Inflation at least had, one win for the bulls recently. Jobs data missed expectations the last time around. We do get our latest round of jobs data coming in just a few days now. We're getting close. 2 weeks, I believe. We'll get the latest economic read from the jobs department. That'll be very key to see, again, where this inflation story is going to go. That being said, again, overall, the market is seemingly wanting to push higher for now. And again, I think that might have been the pullback. We'll see. If it breaks it, great. I'd be happy to build positions. Speaking of positions, I am just about break even on my gold position that I took yesterday. I took update on all the gold stuff. I went long here, I went long here, and I went long here. And I ended up closing out of my positions, all three of them for profit, right around this point. The problem is, I then took another entry somewhere around here, and this is not even a problem. This is just part of the game. I think I stopped out somewhere around here. Market kept going lower. I stopped out pretty quick, but then I entered again when we started coming into this area where I previously had a really good entry. So I am long gold again, with the stop loss pretty much below today's low. If the market rolls over, I'm speaking about the gold market. If gold rolls over today, then all good. We'll chalk it up. We'll say that's we'll take the loss if needed. But I like the trade still. I still think gold has room to the upside. I've pointed out that on the top setups window, gold is still up there. You got bullish readings. Same thing for euro, pound, gold. I'd like to look at those as well and see if there's anything setting up. As far as I checked yesterday, I couldn't quite justify an entry yet on the euro dollar. See, there's, again, I might miss it, but I was pointing out that I'd like this pullback to here, that would be kind of where I'm interested. But instead, what we've got is today, euro reversing higher, making a push to the upside. So I'd be interested in this one if it does, roll over, pull back further. And if it doesn't, then I missed the trade, and that's okay.
Market analysis, free trading courses, edge finder data, and special offers. What do these things all have in common? They're all available for you right now inside of our free Discord. You can click the link down in the description below to join the free Discord today and get access to all of this and more. Stay up to date with all the latest trading information and A1 content. And if you want to upgrade to our Gold VIP Discord that features every single trade that Trader Nick and our other professional analysts take, you can find the links for that in the description as well. So don't wait, go check out the free Discord today.
So I like euro, I like pound to the upside, I like gold. Pound USD again came back and just narrowly tapped into this zone here, pushed off of that level. To me, the pound looks like it is wanting to go higher. Looks like it might head up to that 1.28 mark that we've talked about a couple times on stream. So watching GU here to the upside for now. Again, no entries for me on these two, but I have my gold entry, so they're probably going to move together, right? Euro, dollar, and gold have pretty high correlation. Dollar yen also just modestly higher here on the day. We've been talking a lot about Japan on the live streams. Do we have any reads on JPY? Not for USD, but we do for pound yen and euro yen. Not pairs that we talk about regularly, but they're on the edge finder. So let's look at GJ. I know this is for the Forex traders out there. This is like the Forex day traders' favorite poison right here is GJ. What do you do any Forex traders here like trading GJ? I know this is like when I watch, if I ever tune into like a day trading Forex stream, they're always looking at pound yen and gold. That is the two things that they're constantly watching. That's like the crowd favorite. Anyways, GJ is just shy of 200. I mean, this one's making a run for it right now. Price action looks pretty clean, I will say. Moving nice here to the upside here today. Again, if you get something like this, that might actually be kind of an aggressive entry, but an entry that I still like. Again, GJ getting a nice reading on the edge finder. Haven't seen, GJ make its way into the picture here in a while, but economic data is kind of mixed when compared to Japan, but you are getting, some strong GDP prints in favor of UK compared to Japan. Services PMI giving us a couple points there. The trend is to the upside clearly. Seasonally, decent time to be long. Retail positioning is short against the pound yen, so that's a bullish signal for us on the edge finders calculations. I might have been a little bit early with my entry, but I don't really mind. If I need to re-enter a few times, that's, something that I've, come to be very okay with my trading is if I get stopped out, no one likes getting stopped out, don't get me wrong, but it's so like necessary sometimes to just get stopped out a few times before I finally find my entry that's right. You might say, well, you should just up your technicals game, but I just think that no matter how good you are with technicals, the markets are just volatile. There's noise built into them, and there's just way too many variables that go into why price goes up and down to try and think that your entries are just going to be spot on all the time. It's just not realistic. Think about it. There are millions and millions of variables as to why gold is going up or down on a given day. Millions, right? There's so many different traders with so many different styles. The chart is moving. And so to think like, oh, well, if I use trend lines, that's what everybody is looking at, and that's going to be self-fulfilling, and that's why it's going to move higher. Nope. What about moving averages? Nope, because other people don't use moving averages, right? There's too many variables. There's fundamental traders. There are people who are simply hedging their mining operations that are active on the markets. To try and think that exactly when the market is going to go up or down, in my opinion, it's kind of foolish. Now, I'm not saying that you can't, use your tools to your advantage, find good levels that do make sense, but I'm just saying don't overestimate the importance of a technical entry. A technical entry should be, to be honest, like 10% of your entire trading process. I really think that people overestimate tremendously the importance of entries, underestimate exits. They underestimate fundamental analysis substantially. They underestimate risk management. They underestimate the importance of having trading capital that is sufficient to actually make decent money without risking your whole account every day. They underestimate how important it is to understand thoroughly what an estimated drawdown and expected drawdown should be for you. Like, if you don't have those things figured out, you could have the best entries in the world, don't matter, because nothing is perfect. Nothing is surefire, always going to get you into a trade with no drawdown. Like, it's just, if it were that easy, literally that would be, everybody would be doing this, right? The reason people don't is because they overestimate entries and they underestimate all the other things that I just listed that are far more important. So when I say I'm long in a trade and I'm like, oh, well, if I get stopped out, I get stopped out. I have, had several of my great trades have been preceded by a string of losses. Like, I've tried a couple of times, just couldn't find my bearings. And then finally the right entry comes along and off to the races. So yeah, definitely. I purchased the Edge Finder 2 weeks back. I'm now in a 3-way relationship with the missus and the Edge Finder. Welcome to my life. Just kidding. The wife is number 1, but Edge Finder is like right there at number 2. I'm telling you what. S&P, the market just opened up, by the way, stock market that is. New York Stock Exchange is live. In the opening minutes, we do see stocks just taking just a slight bit of heat here, nothing too substantial. I think we do get some data here this morning, right? It's Consumer Confidence Day. I love the Consumer Confidence Indicator. I think it's very cool. Allows us to look at it again, the consumer confidence, the consumer sentiment. I think it is very valuable to ask a bunch of people what their plans are to do with their spending, right? Like, are you going to go travel this summer? Are you finding yourself spending more on, shopping goods, like for fun, or are you only, are you tapped out? Like, if you could get the sentiment, and that is what this indicator is for, getting the sentiment of the consumer. Kenza, we've got news here in just about 2 minutes. I'm just going to switch over my view so we can watch the reaction. We have the consumer confidence reading here. What are your thoughts on that? Do you ever pay attention to consumer confidence at all? I mean, it tells us a little bit of insight into, again, the consumer's sentiment overall.
Yeah, I actually, this time, even those news where they were not actually important before, but just because now economies are very volatile and things are not going well, so every small economic news start to matter. You see, everything starts to matter. So we have to check everything if maybe we have some changes in the market. So yeah, I do check that. Like yesterday, the market started to sell because of sentiment and PMIs. But mostly, if you go maybe a year ago, those were not really aggressive news or stuff like that. You see, but just because things are not really looking good, obviously we start to look at every economic news so that we can have a clear idea if maybe they are going to cut the rates or not. That's why everything starts to matter. So I don't really see my calendar. Let me check my calendar. I don't know if maybe they are positive or negative. Oh, we left with few seconds.
Yep, we've got just about 30 seconds here to go until we get the consumer sentiment number. I've got it pulled up on the screen here. About 20 seconds to go. Guys, just take a quick second. If you have not already, hit the thumbs up button on the stream, and we've got ourselves some breaking news coming in just a moment. All right, let's see what we got. Consumer confidence. Let's see if it moves anything here this morning. All right, consumer confidence. Let's see if it does anything again. Just a slight blip higher in the S&P, the NAS, the Dow, dollar index just slightly lower there. Gold slightly higher. Let's see if we get anything here. Okay, it was slightly better than expected. in terms of what the consumer is feeling.
Mm.
This is an index, so we had 67.8 being the forecast. We got 69.1. That is that's a beat here, but nothing significantly big. But the bigger picture, I guess, Kenzo, is just the health of the consumer is really important too, because if people are significantly pulling back on their spending, that of course has a huge impact on the valuations of stocks, right?
Yes, and also recession. If maybe there are few people who are not spending, that is also not good for the economy because they have to collect their taxes. So that's why sometimes they might be positive, and at the same time, the stock market can still go up because we don't really want the economy to crash. So that is actually a good thing for now. So
Sure.
I think this will actually push Nasdaq, US 30s to go even higher, maybe even gold, because at least we need a balanced economy. So if consumer sentiment is performing very well, it shows that things are starting to go back, not actually back to normal, because I think now and before we had some like jobless claims were higher. At least yesterday they were a little bit lower. So companies are laying off like employees left and right. That is not really good for the economy also. So yeah, I feel like it's not really that bad. I think maybe we might see some recoveries, even if it's not going to be that aggressive.
I
Okay.
want to ask your thoughts about gold and silver. I went long again. I might be too early. It had a
Okay.
big sell-off here.
Yeah.
Last couple of days really gave back some gains. And I decided to jump back into my trade. I still like the picture, despite PMI data coming out a little hot yesterday. I mean, to me, it still seems like the overall trend is that the economy is showing some pretty uniform signs of slowing down a little bit. And yes, there was some hawkish meeting minutes, but I feel like that's kind of hearsay compared to the numbers. The numbers seem to be coming in a little bit light. So I like the upside for gold here. I think that you've ruled out a lot of the the bulls who are kind of chasing into this move. I think we're out of the woods there, and so I like the entry. If I get stopped out, I'll probably try again around like 22.90 is what I'm thinking. So I don't know, I was just trying to get your thoughts on silver and or gold, either one. What are your thoughts on it today?
Yeah, let's take a look. So I like both, and I like both. Give yourself, a solid runway of 6 months, 12 months. I know you're definitely more long-term oriented on both of them. I'm just looking at gold right now. We did make a slightly higher high. We're getting not a lot of momentum follow through, and from overbought conditions, I guess my one concern would be that. And that doesn't change really anything outside of we're going to see some chop up here. And I think on Monday, during the session, we talked about this look to gold and silver. Gold maybe having a little pullback like this, where it pulls back and kind of resets around 2270, 2275. I think that's another opportunity. I'm also considering buying another tranche of shares of GLD at 2275 or 2270. If it comes down any lower, I'd happily pick up some more around 2250 or so. But I think this is just going to be a pause. Bigger picture, both of them look better. As we mentioned, technically, I still like silver better because it's a measured move to me. We're still in a wave 3. I think gold has made 1, 2, 3, 4, 5. I think we've made a 5th wave move here. 1, 2. This could be 3, 4, 5, and we're just kind of figuring out how to get through this chop right now with a bit of a correction phase. But longer term, I still think central banks are buying gold. It's an alternative play against the dollar. It's an inflation hedge. It's a slowdown hedge. It's a store of value that I don't know has a cap necessarily. So
I don't think so either. And Chris, also, gold or silver, you mentioned silver.
Yep.
I don't know if everybody in the audience realizes how much silver has performed this year. I've got it pulled up on my screen for a second. 34% up approximately since the start of the year. I mean, that is a massive run for silver. And you're talking about something that has been dormant for months and months and months, finally making the move. In my opinion, if it's gonna make a move, it's gonna make the move sooner rather than later. Like, it's either going to, like, I think that the chance of this thing either going way up or way down is more likely than us just like, okay, it just stays here I don't think
Right.
that happens. I think we either, like kind of find support in this recent rally and go higher. That's what I most likely think. Or we just completely fall apart and the Fed starts hiking rates again. That's the other scenario.
Right. But is the Fed going to start hiking rates?
I don't think so. I don't think so.
No,
Not
I
ahead
don't.
of an election. That would be bold.
Look, I was talking about this morning in my previous session. Right now, the Fed has shifted. We talked about this this week several times, but the shift has happened once again in the Fed expectations. Right now, the market's looking at possibly the first cut in November. September probability is down.
Yep.
Where if I look at the, let's just go back to the histogram. September is actually showing a lower probability of a rate cut now. 49% that there's no cut and 45% that there is a cut. But November creeping up here with 46% probability that they make the first cut. I'm like, that is a gutsy play to have November 7th FOMC with a rate cut on the table with an election on the 5th.
Yep.
That's a really crazy, and I know the Fed is not political, but that is totally a political play if that happens.
Is crazy there, yeah.
And I don't think it's like that would be disruptive if they do that. So I think there's either no cut, or in order to, I think the concern would be if there's a no cut scenario, then the market's going to price in a no cut scenario earlier as opposed to right during the election, because historically Q4 is always typically bullish. Q4 to Q1, it's a pretty good runway for the markets. But again, we don't know. We don't know what's going to happen. It could be a really crazy election. There could be a ton of volatility. I still think the market's going to find a way to shrug it all off and try to melt up higher, whatever happens. The market could probably justify, if you look into the manure of what's happened in the markets fundamentally. Somebody can make the excuse and say, well, it's because Trump wins and this is why the market's going up. It's because it's the incumbent and Biden wins another term and the market's going up. But one thing I heard yesterday was pretty important. This is a good saying, that politics don't matter, but policy does. So if we start to see any policy shifting, then the market takes notice. But politics, we deal with that crap all the time, and it's just a bunch of noise and circus in the background.
Yep, makes sense. I was actually talking yesterday with I do a podcast for marketpulse.com, and I was on the podcast with the guy is from the UK that does it with me on there, and he was pointing out that UK elections have just been announced for July 4th, which is also kind of just adding to the overall story of maybe there's some volatility coming this year, whether it be from the US, whether it be from somewhere else. I think there was also like boats parked outside of Taiwan, but the thing for politics, I'm the same way. Like I can't predict or measure that at all. Like it's just so suddenly it's on the headlines and very hard to predict what's going to happen next when it comes to, presidential elections or geopolitical tensions or things like that. All I can really do is look at price action and look at the economic data that's in front of me. That is, the two things that I make up most of my decisions based off of. So, I just thought that was worth mentioning. You can get so caught up as a trader just chasing, news article headlines. And that's really not usually a great indicator even.
I said this yesterday in a class that I taught, throughout my career, I'll talk Forex for a second, because through my Forex trading, one of the most technically obedient markets that I've ever seen. You want to know what to do in Forex. If you could just put on blinders and just trade the charts, you're probably going to be a better Forex trader. Now, I will say that if you're a Forex trader that doesn't use stop losses, you're going to have some problems, 2008, 2009, 2011, 2016, 2020. We've had some flash crashes. I mentioned great financial crisis, the US downgrade and sovereign debt crisis in Europe. I mentioned Brexit and COVID, of course. So those four elements, and then you put in 2022 with the Japanese yen, some wild stuff happening there. So obviously, trade what you see, but have a plan. It's all about risk management. And I just think it's interesting. Like if I never focused on the news and I just traded the charts, the Forex market, the Forex side of things would be pretty straightforward. You just trade what you see. In stocks, it's different. In stocks, you have to just remember the market will find any reason to latch onto something to make it move higher. We're talking about right now, it's no longer the Mag 7, Nick. It's called the Fabulous Four, because now it's Meta, Nvidia, Google, and Microsoft. That's it. That's your Fab Four. Right now, that is 19%. of the entire S&P, and it's responsible for over 35% of the entire S&P gains this year. Those 4 stocks.
Yeah, it's crazy.
It's crazy, right? It's so concentrated. So my point is, like, the market's latching on to AI, the market's latching on to NVIDIA. NVIDIA is now top 3 in the world market cap wise, and it seems like it can't be stopped. Again, does it matter if they do a 10-for-1 split? Is everyone going to jump in and buy NVIDIA at $95 instead of $950? Maybe not. I don't know. So it's just the market will find a way and find any excuse to try to rationalize going higher, but doesn't mean we don't have certain windows where we're going to have a correction. I think that this year the market will likely not dump as aggressive as like the perma bears out there are saying. I think we're going to have a volatile year, but I think the market ultimately, after being up 10, 11, 12% for the year, is going to do what it can to cling to those gains.
Did you know we do a live trading show Monday through Friday with guests from all over the world? To get notified when we go live, click the bell button next to the subscribe button or check in at 9:30 a.m. Eastern Time. We have helpful, free content in the description below and on our website, a1trading.com. Thanks for watching today's video, and we'll see you tomorrow.